Hey everyone, welcome back to Corporate Decoder. Today, we're diving into the latest annual report from Everest Group, and let me tell you, this one's a bit of a roller coaster. We'll unpack why even a company that literally handles risk management can still get a few financial surprises. Let's start at the very beginning to get an overview of what we are looking at. First off, Everest is a pretty big player in the reinsurance and insurance game. We're talking about a company with almost $14 billion in shareholders' equity. So, what exactly do they do? Think of them as the insurer for insurance companies. If a major hurricane wipes out an entire coastline, Everest helps those smaller insurance companies pay out all those claims. Everest operates in over 100 countries and underwrites both reinsurance and insurance. The company works through brokers and directly with clients, giving it flexibility in the market. Everest has many active operating subsidiaries, each rated A+ superior by AM Best, which is a credit rating agency for insurance companies. These subsidiaries are located all over the world from Ireland to Singapore, and the rating indicates a great ability to meet policyholder obligations. Now let's take a look at the people powering this operation. As of February of 2025, Everest employed just over 3,000 people. The filing talks about their strategies for keeping employees happy, talking about opportunity through unity and colleague behaviors. It's all about creating a good culture to attract and retain talent, which is crucial in a complex industry like insurance. Looking at how they get their business, about 65% comes from broker reinsurance, around 28% from insurance, and the rest from direct reinsurance. They really value their long-term relationships with clients and brokers. Here is a breakdown of how the company organizes its sales. The company has two main sources of active sales, reinsurance and insurance. The company also has a third one named Other. The Other group manages existing policies and settles related losses, but does not actively sell reinsurance products. Everest's strategy involves careful risk selection, strict underwriting, and adjusting their business mix as market conditions change. Basically, they want to be profitable, not just big. If we take a look at the table of contents again, we will go straight to the risks so that we can identify the key issues that might affect the company. One of the biggest risks they face is, of course, catastrophic events. Think hurricanes, earthquakes, terrorism events that can cause massive payouts. They use projections to manage this, but actual losses can exceed those projections. They provide the example that in 2021, catastrophe losses hit over $1 billion. Here's another biggie: inaccurate loss projections. If they underestimate how much they'll have to pay out, they could be in trouble. To see a big impact, scroll to the middle of item 1A. We can see here that they note that they rely on claims data supplied by ceding companies and brokers, along with other data. If this data is wrong, their projections get skewed. For example, in the quarter ended December 31, 2024, the company increased its loss reserves by $1.7 billion. Loss experience in these lines of business is very unpredictable and has been exacerbated by social inflation factors such as uncertain legal system outcomes, increased frequency of high-severity claims, and third-party litigation funding. Of course, not everyone always holds up their end of the bargain. Therefore, the report points out that if their insured, intermediaries, or reinsurers fail to pay up, that could reduce their income too. Let's move on to the second part of this report, and let's talk about item 5. Market for registrants' common equity, related shareholder matters, and issuer purchases of equity securities. We can see a small table that breaks down issuer purchases of equity securities throughout the year. Since the company is publicly traded, you might be interested to see the shareholder return over the last 5 years. In this time, they slightly outperformed the S&P 500 with large fluctuations. The most significant growth for the stock has occurred in the last year. Here's where it gets interesting: the financials. First, net income decreased by 45%, primarily driven by unfavorable development in U.S. casualty insurance lines of business. On the other hand, net investment income increased by 36%, a bright spot helping to cushion the blow of the loss. The combined ratio, a key measure of profitability, worsened to 102.3%, suggesting that underwriting was unprofitable this year. Broken down by segment, we see more insights. The reinsurance gross premiums increased, but its underwriting gain decreased. The insurance segment, on the other hand, experienced growth in gross written premiums, but had a massive turn to underwriting loss this year. The company is constantly trying to maintain certain capital levels, and their income depends on being able to invest that capital wisely. As of December 31, 2024, they have 41 billion in investments in cash. Most of it is in fixed maturities like bonds. 96% of those are investment grade, meaning the risk of default is low. They also have a smaller portion in equity securities and private equity, which can offer higher returns but also come with more risk. Interestingly, Everest specifically states they don't have big investments in commercial real estate or troubled debt, a good thing considering current market jitters. Now, something new this year, cybersecurity. They go into detail about how they're managing these threats, aligning their practices with industry standards. This is increasingly important for financial companies because of systemic risk due to digital dependence and thus increasing possible losses. The company addresses a number of regulatory factors. Something worth highlighting is a new tax law in Bermuda that could significantly affect the company's taxes starting in 2025. There is a high degree of uncertainty as to how this plays out. Lastly, there is a mention of the company board's oversight responsibilities. As of this year, the board now has a tech and cyber committee in order to emphasize the importance of information technology governance, including data privacy and security. One last thing to note, the company did undergo a CEO change in January 2025. James Williamson stepped up to take the lead after the previous CEO's departure. Looking at Everest's overall direction, it seems like they are doing great despite several significant market headwinds, which also created some large adjustments on their financials. Overall, this seems to be a relatively profitable company. While I like their growth and increasing investment, the big reserve adjustment is concerning. It shows how hard it is to predict and manage risk, even when that's your main business. So far, it doesn't seem like it will hinder the company's financial fitness. In conclusion, Everest Group is a complex company operating in a risky industry. They are facing market headwinds, but are also expanding and becoming more robust and aware of the risks in the future. Thanks for watching. If you enjoyed, please subscribe, like, and comment.